Group.
Are you telling me that you have a way to defer the tax situation there? Is that what you're telling me?
Yes, absolutely. Yes. And so the first one I was referring to is a 1031 exchange, which only applies to investment real estate. The second one I'm referring to is called a deferred sales trust.
A real eye-opener to see that there are ways that people can use the regulatory framework, if properly structured, to invest 1031 exchange dollars in things that you would not think were like kind to what they exited from. So it was very impressive. I got to say, you are the first one I've seen pull this off, and I'm pretty hesitant to believe in a lot of these kinds of things. So it's a major feat for me to say, wow, this actually really worked, and it was really cool.
1031 is a way to shelter your income when you sell the thing. The DST is a way to avoid the 1031 and not have to suffer the time penalty.
Our career and during different tax periods, we've seen, these tax avoidance, tax minimization, offshore, all these different strategies undertaken to minimize or avoid taxes. And then I can tell you that, some of them are just not worth the trouble. And so I was skeptical. Admittedly, I was skeptical. I thought, oh yeah, here we go, another one of these, right? And then they say, no, it really is different, right? So look more closely. We looked more closely. We had, honestly, 2 years of conversations. 2 years. Now we were being due diligence at the same time that we were doing due diligence, but 2 years is a long time to be, sort of flirting with the idea of and getting to know the people and getting to really understand the transaction. Yeah, long story short, we got comfortable, although we are not tax attorneys, lawyers, or estate planning attorneys, that at least, from an investment perspective, that, it made sense to sell a highly appreciated asset, get liquid, hold that in this type of a deferred or installment sale type of instrument, and then just be in a position then to do the most important thing. I'm probably stealing your next question, which is time. They say, well, you can't make more time. You can. The deferred sales trust, in a way, allows you to lengthen the investment time horizon for those assets after getting liquid, but before having to feel the tax impact. And from an investment manager's perspective, time horizon is the most important element in investing.
Hello, everybody. Hello. Welcome, everybody. Welcome. How are we doing today? Happy Friday to everyone. Excited to be here with everyone on another Capital Gains Tax Solutions Mastermind, live from Las Vegas. Just leaving a multifamily conference. It's called the Multifamily Wealth 50 People-ish that are entrepreneurial real estate and investors and syndicators and operators. Finance people there, people who are developing, and so I am pumped. Hopefully, so I'm happy to be with everybody. I want to encourage everyone to, as you have comments or thoughts or questions, to put them in the chat. We're live right now, and if you want to join us next week, you can go to Capital Gains Tax Solutions. We believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, and not having a clear plan is the main me. And having something like a deferred sales trust is an amazing way for you to plan. You don't have that team. You don't have a strategy to exit. You're looking at thousands of millions of dollars of capital gains tax, and we found that most clients want to have something that's flexible, that is off debt, to keep liquid assets or illiquid assets, to have just freedom with their wealth when it comes to exiting. You might have built a business for 10, 20, 30, 40 years, and you're looking at the largest tax bill that you may ever see, and you're saying, hey, how do I create wealth, and how do I keep more wealth for me and my family in a way that creates either passive income or opportunities to start new businesses, opportunity to travel, have a little time freedom. Whatever you're looking to achieve, we're here to help you build that plan with a strategy such as the deferred sales trust. That being said, I am, for those who don't know me, by the way, my name is Brett Swarts, and I'm founder of Capital Gains Tax Solutions, but I'm also joined by some amazing people like Jake Miller, like Pierce York, like Jake Carpenter, Paul, Micah as well, Micah Miller. But we'll start with Jake Miller. Jake Miller, certified financial planner. How are you doing today, Jake?
Doing very well, Brett. Having a fantastic day so far. We've been meeting with several very entrepreneurial individuals who are perhaps coming up on the sell of their life. And we've been having some wonderful conversations about how the deferred sales trust can be that key thing that helps them reinvest with the gross proceeds rather than after taxes.
Absolutely. And Pierce York, coming off a couple of days, learning from some multifamily experts and entrepreneurs. How you feeling today, sir?
Feeling great, man. Feeling real good. Excited. As Jake said, we had some meetings this morning, so got some good meetings later. Got a good one right now, so pumped.
Excellent. Jake Carpenter, you want to say hi from the great state of Washington?
Hello. Happy to be here. Everyone's looking good. Having some great conversations with some folks in San Diego. A $30+ million deal. They don't want to sell high and buy high.
Yeah, still high buy high with even higher interest rates, right, for debt as well. Micah, how you doing? And Micah, by the way, will be kind of moderating as well as we go through with questions and thoughts. If anyone has any, you can put it into the chat. Micah, how are you doing today?
Doing fantastic. Doing great.
Excellent. Great. So let's dive right in. The topic today is called Building a Capital Gains Tax Exit Plan. Yes, it is the name of the book. If you haven't got the book yet, go to Amazon. We got a book. Jake Miller is in the book. We have also Kevin Harris from the book. In fact, we hit number one. I don't know if anyone saw this. We hit number one bestseller. It was the downloads and everything that. So I take everyone into the real estate category and in the wealth category, which is pretty amazing. So for I think 24 hours, we got in that category. So that's a cool, really big announcement. So I'm really proud of that. Thank you for everyone's support out there. Thank you for everyone who downloaded. Even people who are buying the book. Thank you. We do believe it's pivotal to be able to educate people as we can through what we're doing now, masterminding and YouTube videos and podcasts, speaking at conferences, but also writing books to really detail the thoughts. And so you can pick that up. It's called Building a Capital Gains Tax Exit Plan right now by going to Amazon and just searching Building a Capital Gains Tax. Go over a little bit more of the vision, and then let's just dive into some live deals and let's just start answering questions for everybody. I think that'd be a great use of our time today.
You know, our vision has been evolving a little bit. I believe that today our vision is to help liberate individuals and to bring back the freedoms of choice and the freedom of time, in the sense that now time is back in their hands with the deferred sales trust. They do not need to necessarily pay taxes this year, even though they might have the biggest transactions of their life this year. So essentially, our vision is to help people with highly appreciated assets be able to sell those assets and diversify the proceeds into new assets while deferring the taxes and increasing their net worth.
Perfect. And what are those taxes? Where somewhere between 25 and 50% of your gain is going to be hit with capital gains tax and depreciation capture, depending on number one, what you live in, depending on number two, what kind of asset it is. And so we want to make sure that, hey, look, if you've built something for many, many years and you've been a great steward of building that wealth, building that business, and now you're going to exit, it's like the fourth quarter, 10 seconds to go, and an opportunity to have an extra 25 to 50%. The first ROI here, and it's really important, sales trust is an investment and not just an expense. And that first part of that ROI is that 25 to 50%. So let's do some math. Let's imagine you're selling a $10 million car dealership. Okay. Let's imagine it was a basis. You built it from scratch for 25 years, 30 years. And you have no debt on it to keep it simple. If you were in California, you're looking at minimum of 37%, probably higher to 40 to 45%. As a C Corp, you're probably looking at upwards of 50 to 60% gain being wiped out. So you could have $10 million if you use the deferred sales trust, or you could have $6 million or $5 million or $4 million, depending on how you've structured your entity and your ownership over the years. And so we're talking about a massive amount of wealth that can be continued to work for you, that can be invested, can be diversified, with no timing restrictions, unlike a 1031 exchange, which is sometimes for people to overpay properties, kind of what Jake Carpenter was referring earlier, and take on debt, replacing that debt. And so that 10 exchange also only qualifies, or the assets, the exiting of certain assets, such as investment real estate. If it's a primary home or a business, or if it's cryptocurrency or stock, does not qualify. And so the deferred sales trust, on the other hand, qualifies for all of these assets. You can use that. And so that being said, Jake, want to add or subtract or to any of that?
You know, and it's kind of interesting, the examples that you were sharing there, Brett, because those are literally real life examples of people we've been meeting with and talking with, some of them earlier today. And that I want everyone here to know that we like to work with real deals. We do a lot of educating. The education always means more when it's someone you know or it's your own deal yourself. And so we like to invite financial advisors, CPAs, attorneys, M&A advisors or brokers, and anybody who might be considered an advisor or counselor to a business owner or as someone with a very large or highly appreciated capital asset. Come online with us, come onto the panel, talk about your deal, and get from us the qualifications of, hey, does this work? Does this not work? And if it does work, in what scenarios can it be optimized? And how can it work the best? And I think kind of a segue there, Brett, is when they do that, they now get the new team, or they're leveling up, so to speak, with people who are very specific or subject matter experts to these types of transactions. And that's us. We've got several people here on the call that we've worked with, several people on this call that are part of the team. And I don't know if it's a good time to introduce some of the other people there, Brett.
Yeah, I think it'd be good. I mean, also Rebecca Munson, she's a luxury real estate professional agent up in Lake Tahoe, Truckee area. And I think it'd be good. Rebecca, it's been a while. Good to see you, by the way. And I hope you and your husband are doing great and the family's doing great. You want to say hi to us? And also, here's the question for Rebecca. Rebecca, if someone asked you how this thing works, what would you say? How does the whole thing work?
How does the whole thing work? Goodness. Well, from the real estate perspective, if they're selling real estate, certainly you want to get on one of these masterminds first, and then set up a consultation, no obligation, no cost. And, as a team, you go through the numbers and figure out if it's going to work. You guys are brutally honest and tell people if it does or if it doesn't. There are a couple people online that it may not have worked ideally for. And then, everybody does their due diligence and then go from there. And on the real estate side, you want to do this well before you're thinking about listing a property. Actually, any of the transactions, you probably want to do it well beforehand. But if not, you want to make sure you do it on the real estate side before any of the contingencies have been removed or the last one been removed, ideally. So, yeah.
Micah, you want to add to that, maybe into the nuance of the promissory note and the team a little bit, working together? I think it'd be good. Always love the female touch. Go, Micah.
No, I really appreciate what Rebecca was saying about just the removing the contingencies, because that is a really big part and probably in my opinion, probably one of the things that puts a kibosh to working with the deferred sales trust, and making sure that it's been brought up in enough time so that it's not an issue, it's not a factor.
Perfect, exactly. And so those are some of the components. Right? Some of the components. Jake Carpenter, you want to break down the promissory note and how it's typically, how do you determine the value that's in the promissory note? How do you determine the interest rate? Walk us through that, Jake Carpenter.
Yeah, first of all, it works with any highly appreciated asset, stock, business sale, real estate. Businesses often don't qualify for 1031 exchanges. So basically what we're doing here is at closing, it's a simultaneous close. So you're going to assign the proceeds of the sale, or basically lend the proceeds of the sale to the trust. The trust is then going to buy the asset for, let's say, 10 million, and then turn around and sell the asset for 10 million. So there's no gain inside the trust. It carries back a promissory note, or it's like an installment sale using IRS code 453. You establish, in most cases, our clients say, hey, we don't want to take any constructive receipt of the principal proceeds and pay any kind of capital gains tax. So let's do a zero down payment, interest only promissory note from the trust back to the original seller. And then the original seller can establish an interest rate, usually somewhere between 6 or 8% net of fees, back from the trust to them. And they take a lendership role. So basically they are the lender and they have all the rights to take back the property if the trust itself doesn't perform. So this allows the original seller to work with a trustee, which is Brett Swarts, non-affiliated trustee. He's not a family member. He's not a brother, sister, cousin. He is a non-affiliated trustee. He's a friendly trustee that works with the original seller and Jake Meller and myself as the advisors of the funds to establish an investment strategy and kind of fulfill the income needs that they would want. They're allowed to use up to 80% of the proceeds of the trust to even partner up with the trust and go find active deals that they can work with Brett Swarts on as well. So this allows them to reset their depreciation schedule, re-enter and have an active role in the management of some additional resources or projects if they choose not to be passive.
Perfect, Jake. That's awesome. Great overview. And I know there's a lot there. You might want to rewind that, but he covered quite a bit. And the key to understand is you're changing ownership and you're becoming a lender. Just like if a bank loaned you money on a property that you own or asset or business, you owe them money, but you own an asset. In this scenario, you're changing the characteristic of what you have, your entity being owner, to a lender. And when you do that, you're able to defer the capital gains tax to the extent you receive capital from the entity, which is the trust. But you do receive them over time, and that's the point. And so think of it kind of like an IRA, kind of like a 401k, kind of like a 31 exchange. If we can delay the tax, grow the wealth, it's a great way to create and preserve more wealth. And actually, I would preserve more wealth and then create it. And that's the key here as well. You preserve what you would have paid a capital gains tax and use that to work for you into the future. So good. All right. So we covered some some basic things there. Now I want to maybe talk about some live deals, just some live questions that we've had come up. I mean, they're generally some very similar questions, but what would you say are some of the main questions that you feel we should address today, Jake, from the last couple of calls you had?
You know, Brett, we had a very interesting discussion this morning about an opportunity zone comparison with using deferred sales trust. And I think it'd be good to identify perhaps when you do one, when you do the other, or can you still do both? And if you let, I'll identify a couple talking points and then we can have a group discussion here. A deferred sales trust, you need to have things set up before the time of the sale. With opportunity zone investments, you can do it after the fact, as long as it's still kind of in the same taxable year that you incurred the taxable event from the capital gains sale. So there's that pro and con, right? One requires, or the deferred sales trust requires a little bit more planning. Now, an opportunity zone investment does allow for a future step up in basis, whereas a deferred sales trust provides an ongoing deferral. All right. So a couple of things to analyze and look at. Typically, though, for it to be eligible to be found in an opportunity zone, the investment itself must be at risk, perhaps at risk economically, because it's in an economically deprived area, which is why it is designated as an opportunity zone for investment. So investors who are very conservative in nature need to know and understand and realize up front that yes, they are deferring their capital gains by going into an opportunity zone, and there are a lot of wonderful opportunity zone investments out there. However, they are in zones that are economically challenged. And so you need to know going in that even though it might appear to be a safe and secure and whatever investment, you still need to do your due diligence and make sure that it's the best thing to put your money in. Another couple of items. Typically, an opportunity zone investment comes with a very small rate of return. And it does that because of the tax benefit. There's the two main tax benefits. There's a deferral and then the potential step up in basis. those are the two big things that people are going after that they need to typically is be in the investment for at least 10 years in order to benefit from. Whereas with a deferred sales trust, Brett, we have some of our clients investing in very high rate of return Reg D investments, as well as market, as well as joint ventures with other businesses. There's a higher degree of flexibility. And in fact, one individual client asked, hey, a lot of people are pitching to me this life insurance thing. And he's like, hey, I want to invest in life insurance as well as like maybe a little teeny tiny, like 2% of my portfolio I want to have in an asset that is in life insurance because it is tax-free. Wonderful. In fact, you can actually do that with a deferred sales trust as well. There are mechanisms and ways to do that. And so from a diversification standpoint, the deferred sales trust is a little bit more liberating. Brett and Pierce are always talking about the freedoms that the deferred sales trust allows and gives. Anyway, those are a few talking points that we had in regards to the deferred sales trust and an opportunity zone. I just want to end with one more point. Just because you do a deferred sales trust does not mean that you can't take proceeds out of deferred sales trust and invest in an opportunity zone afterwards. Whereas
hey,
if
you nailed it,
in
Jake.
an opportunity zone, you can't necessarily go backwards.
Yeah, you nailed it too. And I think here, and it's a good point to bring up, that would invest it in that opportunity zone if it wasn't for that. In other words, are you letting the tax tail wag the investment dog? And by the way, some of the opportunity zones, you have opportunity, well, any opportunity zone, as long as you hold it for more than 10 years, the actual investment in there, you're going to have some capital out, like a new basis, right? It's when you exit that. Now you do, the key though is 10 years, right? So most real estate investments that over the years, typically 3 to 5 years, right? And so to have to wait a whole 10 years, you have to ask yourself, is that really what you're looking for? I don't know how it is behind me with the if we're talking. Is it overwhelming with the people talking in the background? Or is that okay? Okay, good for that. You there?
Yes, we hear you, Pierce. Go ahead.
Oh, okay, awesome. So I want to just kind of quickly distinguish something. So you mentioned like an opportunity zone. Now, I know there are opportunity zoned, kind of like funds or something like that, where you pull together, an investment that's going into an opportunity zone. And then on the flip side, right, there are also properties that are just located in opportunity zones that you may be able to invest in and be able to invest in both utilizing the trust. So I wanted to know how guys, or can you, right, use the deferrals trust in conjunction with the opportunity zone, right? Does it make sense to do that or not?
So the thing, you want to go first, Jake, and you go?
Oh, I was just going to comment that you mentioned something I really enjoy the way that you coin the whole, don't let the tax tail wag the investment dog. So sometimes
sorry, Jake, you go ahead. I want you have a good thought. You go ahead.
Sometimes it's really hard that right investment. And so don't make the tax force you into an opportunity zone. However, should you deferred sales trust for the transaction, now you've got the freedom of time. So now you can find that good investment. And if that good investment happens to be in an opportunity zone, then you can take a distribution from the trust and invest it in the opportunity zone and then benefit from all the things that the opportunity zone provides you. But
one little caveat to that. So it's 180 days, right? So part of one of the advantages of the zone is if you close an asset, you have 180 days to put it into an opportunity zone fund, right? So you have that. So as long as it's within that 180 days, correct. And I could be off on this, Jake, and I'd have to double check. Maybe the deferred sales trust to buy you more time on that 180. But my understanding is, yes, you could go into the DST, and as long as within 180 days of that DST that you were to come out, you could put it into an opportunity zone. Do you want to clarify that point real fast?
Absolutely. So that is important. The deferred sales trust does provide you freedom of time in a very big way, whereas you are still subject to the opportunity zone requirements of 180 days after the transaction. You identify the investment, then you days to then deploy funds into the investment. And so there are some tricky things to be cognizant of, and not always able to find that right investment. So again, just because an opportunity zone has a tax benefit, you don't necessarily want to lose your investment if it's not a good investment, or you don't necessarily, if your objective align with a 4, 5, 6% rate of return, or something a little more conservative or meager that a lot of opportunity zones offer because of the tax benefit, then we'll check sure that you're making the right investment and that we can shelter the tax ramifications, then seeking for the tax answer at the risk of the investment.
Yeah, absolutely. And the opportunity zone's got a lot of attention. And I think they were hotter a couple of years ago when people were still finding some deals, and maybe there's some more deals with the market shifting. Part of her being at the Family Wealth Project conference here in Vegas for the week, we're talking about that this transition of people who have overpaid for properties and perhaps their debt is resetting and they're running out of what's called rate caps. So their debt that's fixed is adjusting, and there's going to be some distress that's coming out here in the commercial real estate world. And so the first thing is, would you have bought that? Number two, do you long-term horizon? 3, go with it, like with these own deals. You put in $1 million, or you buy a property for $10 million. You need to actually increase the value and invest into the asset by another $10 million. So you got to double that. So that means typically it's ground up development, or it's just a huge rehaul or tear down of a property, or mostly tearing it down. And so it's just a very small sliver. And the point of saying all this is we actually don't come up against opportunity zones very often. You know, the idea of it is exciting, but the practicality, I don't necessarily see them. I haven't seen them. All the commercial real estate people that we work with, maybe in the very beginning when they came out, when values of real estate was still pretty good, versus it being so highly appreciated the last couple of years. I just don't practically see them. But if you do see them, you know, take advantage of that, right? And the cool thing about the deferred sales trust is you can do a partial. You do partial 1031, partial opportunity zone, partial deferred sales trust. In fact, we often work with people who either sometimes have debt over basis challenges with their investment real estate. We're doing Delaware zero coupon deals, which is another form of the 1031 exchange. And the key here is defining what you want to do with your wealth and envisioning what it means for your time, your energy, the freedoms that you desire, the returns that you desire, right? Number 2, what is your actual, big tax problem, right? Or challenge with the asset that you're selling? And that leads to really number 3, what's the team to help you build that, and the strategy or strategies to help you accomplish what you want to accomplish. So that being said, Michael, you want to add anything?
No, absolutely. I mean, you kind of touched on this a little bit, but making sure that the investor kind of asks themselves, okay, would I want to invest in this whatever it is, be it an opportunity zone or this real estate deal? Would I do that with fresh money, or am I only doing this because I feel pressure from a 1031 exchange and my time that I have? Because a lot of times the investor will get into a situation that they don't know about their contracts that they have with existing lords. They don't know about conditions of roof or the plumbing, or a lot of times they're actually trying to escape that area. They're selling their property because they hate being a landlord, manager, property manager, right? And they turn around and do a 1031 exchange when they see the tax ramifications. And unfortunately, if you don't do your due diligence and you don't have the time to do your checking already, you could be in a lot worse situation.
Yeah, that reminds me of Warren, right? Warren and Catherine are helping to sell the property in Placerville, Sacramento, California for $2.6 million. And we did an analysis, and their NOI was about $120,000. They didn't have any debt on the property. Their tax liability was going to be over $1 million tax. And so they were looking at the deferred sales trust for a number of reasons. Number 1 was getting out of the toilet trash liability, astronomical increase in insurance costs, all of the fires and challenges going on in California. All the places were almost burnt down. The last couple of years, it's been kind of horrendous. Increased insurance, you have rent control in place. In other words, it's becoming harder and harder to do business in a profitable way in places like New York, New Jersey, especially California. It's a big challenge. But beyond that, they have 2 twin daughters, and they had kids a little bit older in life, and they're finding that, wow, this is a great time to travel, to spend time with them, not to have it to drive 4.5 hours to be at a property on a Saturday to fix a plumbing issue or work with a property manager or whatever it might be that's constantly happening at the property. And so we assessed their motives and their desires as it pertains to their wealth plan, and they were so used to just always managing, always having properties. And I can tell you, Warren actually shared his story about a month and a half ago, and I talked to him last week. He's like, it's just so freeing to know that I'm diversified. I had no replacement property. I'm not having to deal with that particular prop California. And I'm saving all this time to be able to spend with my family, which is the most important thing. I can't those times back with my daughters between 10, out of the house. I got 8 years. I've got all this extra energy, less stress, and just the freedoms that I want. And so if you're listening to this, I want to encourage you, if you're looking at selling, to really clarify what is it that you want. Where are you now? A, B is where you want to be. And what does that look like if you were to be able to use the deferred trust? Unlock the freedoms. I think sometimes too, we can clarify what we don't want, clarify what we do want. Working on another opportunity in the Monterey area for a seller who's looking at a 1031 option or not selling at all, or looking at the DST. And we can look at all of the things that we don't want, but sometimes it's really good to say, hey, what do I really do want? And I tend sometimes to, I think generally speaking, as humans, we just tend to go, oh, what's the worst case scenario? I don't want that to happen. But what we think about tends to be what we move towards, right? Where we spend a lot of energy, where we put our energy towards flows towards that. And so I would encourage everyone to clarify, what is it that you do want, right? And if you were able to unlock that using something like the deferred sales trust, hiring us to be a part of your team to help you execute that, what would that mean for you and your family, your wealth, on so many fronts? So that being said, I want to open up for questions now for anyone who's out there listening to us.
Jump in here really quick.
Jay Carpenter, go. Yes, sir, go.
A lot of times what I feel like people feel is just a lot of pressure. And the decision is either, do I pay the tax? Do I do a 1031 exchange? Do I try to get into some opportunity zones? What is it that I do? And what may be the most desirable decision is to consider the deferred sales trust to go into just to hit pause for a while. If you really do want to do a 1031 exchange, let's start with a 1031 exchange. Let's try to identify the property of your dreams in 45 days. But if it doesn't work, we can defease out of the 1031 exchange into the deferred sales trust and give you some time should that 1031 fail, because you don't feel the pressure of if it fails, then you've got the big tax bill to pay. Now you're in the deferred sales trust, and if you want to go into an opportunity zone, great. Again, you've got that 180-day window. You can drop out of the deferred sales trust and go do it, but you've got time to look for it. And then on the third note, if you're considering potentially just paying the taxes, why not park it in the deferred sales trust, and then you choose how and when you want to pay the tax on those proceeds. So really it gives you time, and it gives you flexibility to do opportunity zones, to try out a 1031 exchange out of the gates, to control how and when you pay taxes. So that's why my clients, I just had this conversation with a client that Brett and I closed not too many months ago, who said, I was just really thankful to be able to hit pause for a few years and then decide what I want to do in 3 to 5 years down the road.
So well said. And that's what we believe, that the deferred sales trust was created for times like this, especially in this transitionary times, whether it be for your life and your time, your energy. If you're looking to retire, looking to be a little more passive, unlock those freedoms, but also just the economic times of change, where it's not great to be in debt. It's also amazing to be diversified, to have liquidity, to have options, to have flexibility, to have optimal timing. And so we believe there's a number of perfect storms that are happening, and the deferred sales trust can be that safe harbor where you can have calm waters and a chance to reflect, a chance to plan, a chance to not to rush. Any had clients wait in the bank, especially the last few months, is uncertainty in real estate, uncertainty in the stock market, and uncertainty just what they wanted to do. And they're sitting, T-bills is paying around 4 to 5%, not bad. And these are the types of things that we want to make sure that you have the flexibility. That being said, I do want to open up for anyone who's here. We have Frank. Hello, Frank. We have Jay Fran. We have Kevin. I'm looking at some new folks here. It's like Tony, maybe. Edward. Feel free to unmute. We always love new folks that are coming in or just repeat folks that have been here just a few times to say hello to us. It encourages us, or ask some questions or thoughts or comments. You can either put that in the chat, or you can just unmute yourself and ask your question. It could be a live deal, it could be a potential deal, it could just be a question on the deferred sales trust. So who would like to ask a question? Hello, Esther. Esther just joined us as well. And if no one wants to ask a question, that's okay too. We will keep talking. Micah, what questions or thoughts that you want to maybe throw out there to get a little more discussion going here?
Yeah, absolutely.
We have a few more minutes.
So I like these calls because these calls kind of are an introductory. It's just, hey, how does it work? What are kind of the mechanics of it? And it's kind of an open space where you can bring an option and say, hey, is this something that might be a possibility, right? I mean, we don't have to go into every single nitty-gritty detail on this call. It's just a throw up out and say, hey, is it a possibility, right? Because we get into the details when we get a conversation with the attorneys, and we dive into it at that point. And even at that point, there isn't a charge to do so. The charge comes at the end of the transaction, which is kind of cool.
Very well said. And thank you, Edward, for your comment as well. We saw that in the chat. Absolutely happy to help one-on-one. Let me give you also the qualifications real fast. It needs to be a $1 million net proceeds, $1 million gain, and then you qualify. But Mike is correct that if for some reason your deal doesn't close, or you decide not to use the deferred sales trust, you decide to use 1031 or an opportunity zone, and you don't actually use the DST at the closing, then there would be no features. And so it's truly a no cost, no obligation. That includes looking at everything, reviewing your deal, strategizing with you, analysis. It's all here. Part of that is because we believe truly, if you have a chance to digest it and see it and get your arms around it, that we have a very high, we're able to do that. That yes, Edward, feel free to book a time with us, and we're happy to talk with you. That's all I have right now, everybody. I don't know, Jake Miller, if you have anything else to add.
I got a question for you. I got one,
okay,
Brett.
go.
What would you say, is there anything else for a person if they wanted an alternative than a deferred sales trust? I mean, we've talked about a 1031. Are there any other options out there that people might consider?
Yeah, we're always trying to talk people actually out of the DST, honestly. We are spending a lot of time talking to people, like on this education, it sounds like maybe we're talking people into it, but we actually try to eliminate the DST needing it, because it is a long-term type of deal. I mean, we can also set it up for short-term, but it's typically 10-year increments, and every 10 years you renew for 10 years. So it all depends on what you're trying to achieve, Micah. And so if somebody says to me, Brett, why wouldn't I use the DST? What other alternatives besides a 1031 exchange are there? Well, we might look at, current real estate that they own now, and maybe some cost segregation they could apply to those assets that maybe have higher depreciation schedules in place, which can create, with this year, it's bonus depreciation of about 80%. Last year was 100%, but you're typically able to depreciate. Let's say you had an asset for $3 million and you just bought it last year and you didn't do accelerated depreciation. You could probably get about 25% or so of that 3 million if you did a cost seg study today, and you can apply that to your capital gains tax liability in this year. And check with your CPA. These are things that you want to make sure that you double check if indeed you sold in 2023. Now, if you sold in 2022, you can't retroactively go back on 2023 cost seg study and go to 2022. So those are some things to think about. So cost seg is something to consider. Number two would be just actual carry forward loss that you might have had in previous years that could be applicable to your current year. Now, sometimes you don't get the full benefit of all of that loss. So also check with your CPA, but have there been assets that you've sold in the past that had a loss and you kind of forgot that they were sitting on your tax returns carrying it forward? And we've had opportunities where they were used the DST, and then they said, oh, I had that loss, and they were able to apply that. So make sure you're asking yourself those questions there. But in regards to the deferred sales trust, I mean, we say there's been competitors in the sense of there's been a lot of maybe imitators, but never any duplicators, if you will. And the main reason we say that is because most of the folks that are out there maybe doing something similar, and we haven't found to have the track record. The 27 plus years it's been, DST's been around, thousands of closes, billions and billions of deal flow over the years, and never one single change on any IRS audit. So it's adding 1,000. There's also lifetime audit defense that's there. So I don't actually know. And in fact, we do encourage if people have other things to bring them, but we haven't really seen anything that's like it that has the track record. So hopefully that answers the question, Micah.
Hi there, this is Kevin.
Hi, Kevin.
Can you hear me?
I can, Kevin. Hey, welcome. All right, where are you calling from?
Actually, San Francisco, so Northern California.
Okay, great. Yeah, I'm originally Mission San Jose, Fremont. It's been a lot of time out there, so welcome to the call. And go ahead with your question.
Cool, thanks a lot. You just touched on, I think, tax audit protection or what have you with the tax attorney that's involved. Can you talk about how's that played out in the past when there has been an audit? Has it just been of this structure, or is it of the taxpayer's entire portfolio? How does that play out typically?
It's a great question, Kevin. And this is a really important point to understand that the deferred sales trust with all of the audits, in fact, there's been over about 24. The majority have been no trigger audits. What does that mean? That means that the deferred sales trust transaction was not the reason the audit happened. In fact, someone might do a transaction, and when they sold, the IRS just wanted to know about that transaction. And as a part of that, they investigate that transaction and they found a deferred sales trust. And now they're auditing the deferred sales trust. And so the deferred sales trust is not a trigger to the audit. Now it could be, not that it couldn't be, but in the past it hasn't been when it's been no trigger. There's also been formal audits and what's called promoter audits, where they go, wow, this is just happening a lot now. And they start to kind of catch the attention of the IRS. And so they say, we want to look at this in detail and then the tax attorney sit down, and it's not a specific case, it's the actual entire structure, and where they sent the structure. This happened in California. They're in the Long Beach office, state building, doing an audit. And they said, look, just in case we're going to send this back to DC or the IRS, federal office, and let them review it for a few months. And they did. And all of these came back at no change findings. And so if you were to get audited, you would just say, hey, guys, I'm getting an audit, and it's no charge, no additional charge. It's 100% covered by the law firm who created the structure, has a perfect track record, and they would handle it, work with your CPA. They also work with your CPA to properly report the installment sale on your tax return. That's coupled with the trust. And so that's I hope that answers your question, Kevin, or let me know if I made that clearer or if I muddied the waters a little bit.
I have a little comment to make on that too. Just because they're not only offering that audit protection for you as the client, as the taxpayer, it's almost kind of like they want to do it because they want to have that good track record as well, right? It's kind of, it helps them to make sure that it's protected and defended in the correct way for their benefit as well. So that's why.
That's good, Michael. Yeah, it's both sides, Kevin. Yeah, we want to make sure it stays perfect, but it's your discretion to actually hire the law firm, but we highly encourage you to do that. And I think you probably would, but it's up to you on the audit there. That's a good point, Mike. But Kevin, did that answer your question, or do you have a follow up there?
Yeah, no, I think it did. It's not a triggering event. It's more just the sale and having a large capital gain that's going to be the trigger.
Yeah, but that's a good point, because any tax deferral strategy you're looking at, you want to know they've been through audits and or if it could trigger an audit. But more than that, you want to know that the structure has survived, audits, and there's been thousands of closes, and it's 25 years, and that's the biggest thing with the DST that gives me the conviction that it works, it's legal, it's always worked until something changes, and until there's a failed audit or something, it's still perfect. And so, but yet there's those that are cautious, and you should be cautious. Make sure you ask the questions, but as long as we're doing it correctly and we're following the plan and the procedures that have been laid out by the tax attorneys that have a perfect track record so far, we feel confident that we're standing on solid ground. So, but Kevin, what other questions or thoughts, or you want to ask about your deal, or you have a live deal, or what's going on?
One other question was, I guess, in terms of using this as repository for other deals? Or other, let's say I have a separate business I want to sell, and the proceeds from that, can I put it into this commingle of funds, or is it has to be a dedicated investment?
Great question. I'm gonna pass that one to Jake Miller. Battery might die on my whole laptop here at the airport. So Jake Miller, go ahead.
Now, Kevin, talk a little bit more about that investment. Just throw it.
So yeah, to have a, the primary business, multi-million-dollar capital gain that I would use this tool for, but I have another smaller business that might be like, if I sell the asset that's within the LLC, it'll be about a $300,000 gain. Well, taxable, I guess the net gain would probably be about 200,000. So is that something I could lump into this tool and save on the capital gain tax, or is it too small?
So the answer is yes, but the attorney would probably say it depends, because of course every deal, it depends on a little bit more than just the sales price and the gains from that sale. Having the first transaction makes you eligible for the trust, and having the trust, you don't have to set up a new trust every time there's a new deal. You just get a new promissory note. And so it kind of works, especially in the order that you mentioned, to have the big deal first, you're eligible for it, you have this trust, and now all the following deals can just be added to it. Now, of course, it makes a lot more sense if all of these deals are in the same year, because for tax purposes, they all get lumped together in your tax returns anyway. And even if they're not all in, we can look at them on a case-by-case basis to make sure that there's enough tax paying to want to mitigate the tax flow that you'd otherwise have to owe by using the deferred sales trust.
Got it. Okay, makes sense. Okay.
But great question and great example for everybody else here on the panel. So thank you for asking that question.
Sure. Yeah, I don't have anything else at the moment.
Well, we are kind of coming up on the end of our call here. One last call for questions, and then I can see that Brett's got to jump on his plane. We'll leave some contact information if there's nobody else that wants to raise a question, and then we'll see everybody next week. I guess. Go ahead, Kevin. Was there one more thing?
Nope, that was it. Great.
Thank you, Kevin. And remind us again, where are you calling in from today?
Northern California, San Francisco area.
Glad to have you. Please join us next week as well. Jake Carpenter, if people want to reach you, how do they get in contact? And then we'll go to Pierce, and I think Jake's on the phone right now. So Brad, if people want to reach out to Capital Gains Tax Solution, how do they do that?
You just go to capitalgainstaxsolutions.com. Make sure for our YouTube channel, you can book a time. Just make sure you said you found us here. That'd be great. So capitalgainstaxsolutions.com. I'll pass it over to Jake Miller.
And if people want to reach out to Strategic Tax Solutions, they can reach out to us at strategictaxsolutions.com, as well as 1-800-773-1848. Rebecca Monson, how do people reach out to you for luxury real estate in the Lake Tahoe area?
Yeah, RebeccaMunson.com or 530-448-9740.
And then, of course, Pierce York, man in the car.
Man in the car. Yeah, you guys can find me at kingdomluxuryrealty.com if you've got any sort of commercial or luxury residential down in Southern California.
Okay, well, very good. And, well, we'll see everybody next time. Same place, same channel, same time. And come back with more questions, more people that you know that are selling their highly appreciated assets, and we'll see if a deferred sales trust is a good fit for them. Thanks, everyone.
Yeah.